So traders, what exactly is candle range theory? Candle range theory, or CRT, is a trading concept built around a simple idea. Every single candlestick represents a complete trading range defined by its high and its low. When you break that candle down into lower time frames, you will notice that its high and low often act as turning points. That is not random. Those levels mark where liquidity forms. In practice, those turning points become key liquidity levels because they represent the highest and lowest price traded during that period. That period could be a day, a week, or even a 1-minute candle. In other words, CRT is not about predicting random reversals. It is about understanding how price reacts to clearly defined liquidity boundaries inside a single candle. With that foundation, we can combine this structure with smart money concepts to build high probability opportunities. Now, in its classic form, CRT works with 3 candles, and each one has a specific role. The first candle defines the range. The second candle creates the sweep. The third candle provides the entry. Let's break that down step by step. Starting with the first candle, its high and low act as the primary liquidity levels that future price will often target. Since those levels represent the extremes of that trading period, they naturally attract orders and stop placements. For example, in a daily candle, the high and the low represent the absolute highest and lowest prices traded that day. That alone shows how significant those levels are. Even without analyzing lower time frames, we can identify important liquidity areas just by observing a single candle. The upper boundary is called the candle range high, or CRH. In smart money terms, the liquidity resting above this level is known as buy-side liquidity, or BSL, because it contains stop losses from short sellers and breakout buy orders. The lower boundary is called the candle range low, or CRL. In the same way, the liquidity resting below this level is referred to as sell-side liquidity, or SSL, since it includes stop losses from long positions and sell stop orders. This concept can be applied to any candle on any time frame. What matters is how price reacts to those boundaries. Now, when the second candle moves above the CRH and then quickly returns inside the range, that movement is called a liquidity sweep. In many cases, once liquidity is taken on one side, price will rotate toward the opposite side of the range. The same logic applies in reverse. If price sweeps below the CRL and closes back inside the range, it often seeks the liquidity resting near the candle range high. However, there is an important condition. If the second candle closes decisively above the CRH, the CRT setup becomes invalid. In that scenario, the market is expanding, not rejecting the range. But when the second candle fails to close above the candle range high and instead returns inside the range, we can then look to the third candle for a potential short setup, with the candle range low serving as the logical objective. That covers the core idea and the reasoning behind candle range theory. Now let's move to the concrete rules and break down how to trade it step by step on the chart. Now the first question to ask is, which candle should you choose when applying the candle range theory? If you've explored this concept before, you've probably seen that one of the most common methods among traders is to focus on the 1-hour candle formed right before the New York session opens. Why? Because the New York session often produces strong reversals, especially shortly after the open. It typically begins by sweeping liquidity built up during the London session and then shifting direction. This behavior creates excellent trading opportunities. So here's a smart and structured approach. Apply the CRT model to the 1-hour candle immediately before the New York open. If price sweeps liquidity outside that candle's range and then re-enters it, you're seeing a setup that aligns with both CRT principles and the natural characteristics of the New York session. This confluence often produces high probability setups, provided you time your entries accurately and manage risk properly. However, there's one limitation to this approach. It usually means trading against the prevailing trend. Trading in the direction of the trend gives more confidence and consistency in high probability setups. So, is it possible to use CRT while staying aligned with the trend? The answer is yes. There's a refined version of this model that applies CRT logic within trending conditions. Let's break it down. First, identify a market that's clearly trending up or down. Then, wait for a corrective move, because corrections provide both better entry prices and safer stop-loss placement. For example, if the last impulsive move started from this point and pushed all the way up to here, we expect the correction to unfold within this range. From that point, we apply the CRT model only to bearish candles. Since the overall trend is bullish, we mark the high and low of each bearish candle and observe how the next candle reacts. If the next candle breaks below and closes outside the range, the setup becomes invalid and we move on. Then, we repeat the process with the next bearish candle. This continues until we find a candle that sweeps below its low but closes back inside its range. That's when we have a valid CRT setup. At that point, we've identified both the range and the sweep. Now, the next question is, where exactly do we enter the trade? A simple approach is to open a buy position immediately after the sweep candle closes. But there's a more refined and higher precision method. We can zoom into a lower time frame to locate a more accurate entry point. For example, if we're analyzing the 1-hour chart, we can drop down to the 5-minute or 15-minute chart to see what's really happening inside that move. On the lower time frame, more structural details become visible. In this strategy, we use the fair value gaps that appear right after the sweep as our entry zones. All we need to do is wait for a fair value gap to form following the sweep and then place a buy order within that zone. Our stop loss goes just below the gap. For trade management, we can make the position risk-free by taking partial profits when the trade reaches a 1-to-1 risk-to-reward ratio. This way, even if the market later reverses and hits the stop loss, we keep our capital protected. For the remaining portion, we let profits run until price reaches a major structure level ahead. Since this is a trend continuation setup, this combination of CRT logic and fair value gap entries offers a smart and efficient way to trade candle range theory. So trader, please remember that the Com Lucro channel is focused on giving traders clarity, confidence, and structure. And this Smart Money Concept series is designed to do exactly that. Each video breaks down one ICT concept in a clear and practical way, helping you understand how price behaves, where liquidity forms, and how market structure develops. If this explanation helped you see the market with more clarity, make sure to check the full Smart Money Concepts playlist linked on the card and in the description, where all these ideas are organized step by step into a complete learning path.